All right. Welcome to the Cirrus Research session. This session titled Market Conversations. It's basically an interview series. And in this instance, in the very first issue, we're very pleased to have Dave Lundgren join us. He is a 30-year veteran in the financial services sector with an in-depth focus on technical analysis. He's worked in several investment positions in key firms such as Wellington, Fidelity, and several other institutions. He's also led several research efforts over the years, and including a hedge fund. He's also taught at Brandeis a focus session in their business school on technical analysis. Importantly, though, I've known Dave for over a decade now. We, as a research shop, has covered Dave over the years, and in my experience with Dave, Cirrus is a quantitative strategy shop, and Dave is a technician or of technical background. And yet I found over the years that the discussions we've had, the questions, the challenges, given the varied tools that we've used, for really, it's been a neat experience because these components seem to cross over again and again. And so I think that, I think this will be a wonderful discussion. We've had, I would say, an incredibly interesting market, and it's very timely, I think, to have a dialogue looking at various tools and skills. So what I'll do is I'll just open up with a few observations on the market. November was an incredibly volatile period. December's opened up in a very, very interesting way. I'll start with some of the top-down observations we've met, and then we'll go into some of Dave's observations. And I think as we go, we'll have some dialogue as we continue. So this cover slide represents a recent publishing of ours. It comes out of a monthly report called Signals. It summarizes how we're positioned on really major elements of the market. For instance, stocks versus bonds. This asset allocation model that we run, it still remains squarely overweight in fixed income, which is super interesting. That said, the exposures have started to climb quietly in the last few months. In addition to that, the size premium in terms of big versus small, this model has been really in the last few months in a large cap leaning fashion. And in most recent period, it went from an overweight large to a lean large. In terms of growth versus value, the middle section there, the middle card, as we call it, remains about 5-6 months ago, really shifted from evaluating more towards growth, and most recently to an overweight growth. And then finally, in the last couple items, the major change that I'll probably talk about is this idea on our risk appetite measure, how that reading has come down meaningfully in the last few months. In fact, at the end of November, given the drama that we saw there, what we noticed was the risk measure has actually broken through some meaningful low, and I'll walk through that in a second. And then finally, on crowding, we have a fairly interesting measure on market crowding, and that reading up until about 5-6 months ago was basically flashing red. It had called for, since September of the prior year, a broadening of market or a break in leadership. And to some extent, I think from fall of last year, that's exactly what we saw. 5-6 months or so ago, this reading is settled. What we like about this is that the expected returns at market tend to be higher when the market is more even-keeled, less crowded, less concentrated. I wanted to get back to this most recent update that we've done, which is our Cirrus risk score. And without going into it too much, this curve basically registers the risk-taking appetite in the States. We've built this out for several key regions around the world. And what's important about this is that it was really last year, August, September, where this reading spiked to above normal levels. It stayed there for almost, I would say, maybe 9 months. And then finally, about 5-6 months ago, it started to roll over, become where risk appetites were, in my simple word term, stupid high. And it finally started to roll over about 5-6 months ago. What's important, though, is this reading now suggests that the risk appetite in the markets are unusually low. And the big picture of this reading, which we like, is that it is a really important contra reading, meaning when we all love risk, the expected returns for the market 6-12 months out is below average. And when we're fearful, that's really a time where the expected returns in the market are highest. So we think this is super important to discuss because we certainly have a wall of worry that everyone is challenged with, whether it's the tapering dance or yet another new strain of COVID, inflation, et cetera. So I think there's plenty to debate. If we look to a couple other things that I thought was interesting is that's driving the marketplace is that quietly in the last few months, even though we've seen a lot of challenges with innovation stocks, we've seen challenges on reopening stocks. What is interesting is we've quietly seen infrastructure shares quietly start to move up and outperform in the last few months. This chart represents the performance of our Cirrus Infrastructure series. There are 3 performance indices here: large cap, mid cap, and there's also a small cap series as well. We're only depicting 2 with the market in the middle. But the bottom line, though, is that the outperformance that's begun, as we've seen a 1-year window where the performance has actually been quite good. And then recently, the relative performance has begun to improve. So that is something that we're definitely focused on and doing quite a bit of work in. And then the other point is interesting is that if you look at innovation shares, and here we're using one of the ARC ETFs as a proxy, the bottom line is that leadership sort of broke late last year, and we've started to see some sort of decay. We started to see a sideways patterns as rates started to rally back. And then recently we've started to see more of a give up as we're starting to discuss, or as tapering has resurfaced to the top. And one other thing that we're noticing is that in terms of the home and away, the reopening baskets, they had done fairly well, but with this recent second strain, we've seen a pretty serious pullback in those shares. And so that's something to be seen. I think one important nuance is that it's quite possible that investors are now looking away from reopening to rebuilding. So it's possible that if we link this idea that infrastructure shares are starting to work, the away stocks aren't acting well, it's possible that there's a little bit more of a more nuanced trade that's occurring right now. I think we need to see a little bit as we come out of this sort of COVID moment, how the away baskets behave. And then one final observation from our side is how different leadership looks 12, 18 months later. What you're looking at here is a slightly a different twist on momentum. Here we're looking at business momentum. And in this instance, we're looking at things like earnings revisions, trailing earnings, and so on. And if you were to look at those types of firms where the expectation for growth, at least in the forward year, is really strong, a year or 18 months ago, this would have been a 2-sector game. It would have been tech and healthcare. What we're noticing now is consumer discretionary, healthcare, consumer services, materials, industrials are scattered in these portfolios. And so I think some of this bridges to some of the material that I believe Dave is going to also walk through, which is the changing nature of the market and how we've shifted so dramatically in an 18-month window or a 12-month window without like some meaningful mega break in the system. So I think that's super interesting. And so at this point, let me bring in Dave, and let's get a few of his thoughts.
Yeah, thanks very much, Satya. I'm honored to be the first guest in what I'm sure is going to be a very beneficial series of conversations for your clients. So I very much appreciate the invite, and it's great to see you, of course. I think over the years as we've worked together, what I've noticed is that when our perspectives, which we come to from using different tools, when we come down on the same side, those tend to be really good calls. And when we tend to our processes lead us to different conclusions, neither one of us tend to end up with a very good call. So it's what we really try to do is try to find the sweet spot where we both agree, because those tend to be the real good opportunities for the coming 6 to 12 months. So for me, I mean, when you look back over the past year, you just hit upon it, it's been a very, very volatile year beneath the surface. So you have the S&P just kind of trucking along as if there was nothing to worry about, but beneath the surface we've had massive rotations. And the only thing we can identify that's good about that is that while we've rotated, what we didn't do, which is traditional in a bear market, is we didn't rotate into safety. So utilities and staples and that kind of thing, they never really came to the fore in terms of leadership throughout the course of the year. So yes, we've had some meaningful corrections. Satya, you just showed the ARK ETFs. I mean, that ETF is down, 50 or so some odd percent off of its highs, probably more than that. And from my perspective, I can't make the case to own those names, and I haven't been able to for a while. But what the good news is that while we've rotated away from that, we did not rotate into safety, which is what's kept the bull market alive. So we've seen massive rotations in leadership, but the bull market has persisted, reflecting that sort of risk-on structural secular bull market that I think is still in place. So within small caps, if you want to maybe go to page 11, the first page for me,
Yep.
this is a chart that shows the relative performance of small caps versus large caps. So that's the black line there.
Yep.
And you can see obviously after the COVID bottom, small caps with the massive injection of liquidity into the market came roaring back after a massive decline in 2019. And so now we're just kind of left in no man's land. And I just kind of feel that's the way it's going to be at the index level. So I think most of the opportunities within small caps, within even large caps, are going to be more idiosyncratic and fundamentally driven. And when you start to compare the top-down indices to each other, it's just going to be kind of a garbled message. So most of the opportunities are going to be driven by the sort of the one-off stories and the fundamental drivers beneath the surface, as opposed to getting some big factor tailwind. So in the case of small caps, what you can see in this chart is small caps, the black line relative to large caps have mirrored rather well inflation expectations, which is the gray line. And this is just a simple proxy for inflation expectations, just taking the TIPS ETF versus the TLT ETF. And you can see that they tend to move, small caps tend to outperform when inflation expectations are rising. So this is sort of a risk-on metric. So it's not surprising that small caps relative to large caps would sort of move in tandem with this risk-on, risk-off metric. But the point is that as long as inflation expectations are really, as you can see here, they're starting to roll over again. And as long as that's the case, I just think that your stock selection within small caps are not going to benefit from being small caps. So the factor of small caps is not going to benefit. It might even be a bit of a headwind. And I think until we get a meaningful turn in these risk-on, risk-off metrics, I think it's going to be the case. If you go to the next slide, you can see this is a little bit busier. But this is just a series of risk-on, risk-off metrics that I use. So back up one, yeah, there. And you can see how these all basically peaked in Q1 of this year. And that's pretty much right when small caps peaked relative to the market. And that's when the ARK ETFs peaked relative to the market, and certainly in absolute sense as well. And I just think that these are the drivers that matter to the market, and it's what differentiates the attractiveness of one factor versus another. And as you can see, there's things in here from the 10-year yield, inflation expectations, and credit spreads in the top. And then you have banks versus utilities, copper versus gold, the Aussie yen, and high beta versus low volatility in the bottom panel. And you can see how they've all rolled over since the beginning of the year, and that's the driver. That's, to me, that's the line in the sand that matters at this point. And as long as these risk off metrics are heading lower, you know, it's going to be a lot more. It's going to be tough sledding for stock selection within factors that benefit from risk on environments, if that makes sense.
Yeah, you know, Dave, if I can interject, one of the interesting crossovers on the size premium in your call, I think it feels about right, because we've also been talking about on the fundamental side how the profit cycle will continue to grow and expand, but potentially at a slowing rate. And so if you start to see sort of like the you know, you're moving away from the acceleration of earnings, we think that what that forces is more of a focus on margins and quality. And so when you think about it, it puts small caps at a disposition. And so the easy trade is probably behind. And the other thing that's gaping risk within the small cap market is, I've always claimed that that segment is like a two-headed beast. It's it's like deep value situations and aggressive growth, and you put them together and you get this small cap market. And what's interesting is that we continue to talk about tapering and risk and rate risk and so on. The growth component, which is fairly excessive, will likely be this sort of like dead weight loss in the Russell. So I think we're coming to this really similar conclusions, but if you peer that fundamentally, I think you have a good backing as well.
You know, I think that's a really interesting observation. If you look at page 14, what we're seeing actually in small caps. So the top, both of these charts are growth versus value, but the top panel is growth versus value in small caps, and the bottom panel is growth versus value in large caps. And you can see that there's a significant difference in the two trends. It's been a massive, typically they move together, but of late, since the latter part of last year, and certainly Q1 of this year, which is what we talked about in terms of all these risk on, risk off metrics breaking down, you can see that there's a massive disconnect within the growth versus value relationship when broken down by market cap. So does that?
Yeah, no, that's we've noticed a little bit of that, but this chart actually fleshes out really well.
Right. So if you go to the next page, this is just again something that I've been following all year, and you know, with me being a trend following, momentum, technical type of investor, you can imagine why. Not only have I not been long in this space, which is this is the family of ARC ETFs. This is the various ETFs that are available, but these have actually been some great shorts as well. So we're quite extended down here, which you mentioned, and I'll show you some slides as well that suggest that the market's really in the past week has become very extended and sort of oversold on the downside, ripe for a bounce, which corroborates one of your observations as well. But you can see that as long as these charts look like this in the ARC ETF family, which is sort of the hyper growth, transformational type technology names, as long as they look like this, you know, I think we're just going to have to be looking for other places for leadership, because it's certainly not coming from here.
Yeah, definitely. An anti-arc curve, I guess.
Yeah. So the arc is sinking. The arc is sinking, so we need to either bail water or find another ship. But to your point, and I really think this is interesting. You know, when you talk about rotating into infrastructure type stocks, which is important. So like when you see leadership break down like this, the first question you should be asking yourself is, well, if it's coming out of here, where is it going?
It's going. Yeah.
And as long as we are not going into staples, utilities, REITs, and things like that, which is the market's indication that it's hunkering down for a safety event,
right?
We're fine. We just need to find out what that leadership is. And I really like the idea of the infrastructure coming on, interestingly, at a time when the opening economy stocks are starting to falter. So the market's being really specific in the bets that it wants to make. So you know, that's definitely something worth keeping an eye on as we go forward. You know, another thing I like to really watch, particularly being a momentum investor, is if you go to the next page. This is the momentum ETF, so that you can purchase the momentum factor in the form of an ETF. It's MTUM. And on the bottom, that's the momentum factor relative to the market. And you can see that over time, we all know this. We may not like it, but we know it. The momentum tends to outperform the market. And we can see this playing out here on this chart. But what we've noticed is again another example of this sort of breakdown in leadership. As the market moved, as the momentum ETF moved to new highs more recently, the relative performance has really tapered off considerably, which is an indication that the market once again is rotating. And so when we look on the left-hand side, what we can see is, as it stands right now, 35% of the momentum ETF is in technology. And then financials are the second, and then healthcare is the third.
Yeah.
Importantly, as we're seeing all this rotation, what we're not seeing is we're seeing utilities is 0%. Staples is like 3%. So in a bear market, those two sectors will work their way up. How do they do that? Well, they oftentimes in a bear market, they work their way to the top of the relative performance rank by going down less.
Yeah.
And we're not seeing that at all. So that's a big plus.
Would you say a year, 18 months ago, when you looked at the components in here, what do you think the tech healthcare weight was back then?
So that window of time, of course, is just right around the COVID situation.
But let's say last summer, or I'm sorry, summer of 20.
Yeah, so summer of 20, which would have been just after the COVID.
Yeah.
Yeah. So it was technology in a very interesting way. As the market fell apart, technology continued to lead throughout the COVID crisis. And then when COVID bottomed, they retained their leadership up until recently. In fact, the XLK, which is the technology ETF, just recently hit new relative performance highs again. So within there, you have semiconductors, and within there, of course, you have software. Those are the two most dominant, most persistent leadership groups within the market for the past, say, 10 years. And as we've gone through all this rotation, what we have noted is that within technology, and again, you can see technology is still the largest sector exposure in the momentum ETF. That's largely, again, going to be semiconductors and software. And you can see that they're dominating the momentum ETF, and in the technology ETF most recently just hit relative highs again.
Okay.
Yeah.
Great.
But when you do the same analysis on the small caps, which is the next chart, again, this chart shows the relative performance of small cap momentum versus small cap index. You can see a big collapse again in the relative performance, which started in the latter part of 2021, so sort of ushering in what ended up becoming a highly rotational environment.
Right.
And when you look at the sector representations within this sector, you have discretionary financials, healthcare, industrials, and then technology doesn't appear until the fifth one. So within small caps, it's a much different makeup in terms of what is leading. But what's most important is that all of the safety sectors are at the bottom still.
Yeah. Interesting.
So as small caps have struggled, as they've struggled, they're still struggling, but within themselves, their leadership is still cyclical. And that's super important to pay attention to as time goes on.
Very good.
Yeah. Okay.
Well, terrific. Any other comments, observations?
Yeah, I think maybe if we hop over to 22, this is, I'm sorry, not 22, 23.
Yep.
Yeah, so this is a series of indicators that I monitor for indications of how extended or oversold the market is. And what you're looking at here is, if you look at the middle panel that says percent stocks above the 250 and 20. And when you get a majority of stocks that are below their 20-day and the 50-day moving average, which you can see down here, just a little bit lower there on the right.
Yep.
Right in there, that's a very oversold condition. And when you get an oversold condition like that within the context of an uptrend, which we can clearly see we're still in, that's generally a good indication that selling pressure is over, and then you can start to look for other triggers to indicate that sort of like to sort of triangulate the conclusion to make ensure that we're near a trading low. So this is called breadth, like the percentages of stocks above and below various moving averages. We can say breadth is definitely oversold here. If you go to the next page, and you're looking at volatility, this is the volatility index in the middle panel.
Sure.
And then the bottom panel is the VIX curve, which is just comparing the 1 month volatility to the 3 month volatility. And whenever the 1 month volatility gets higher than the 3 month volatility, in other words, investors are reaching into the future and pulling the fear of volatility into the pricing of the 1 month VIX relative to the
Short
3 month
term.
VIX.
Yeah.
Yep, you know that people are freaking out. So here we have two charts showing that the VIX is spiking above 30 and the VIX curve inverted, so it went above 1, all during this oversold condition, which I indicated with the breadth on the previous page, all within the context of an uptrend. This is just a really low risk point to be taking the other side of this recent weakness and just actually, at minimum, stop selling. If you're short, cover shorts, and if you've been looking for names to on your preferred watch list to buy, when you're oversold like this in the context of an uptrend, this is a good time to pull that trigger. Just another one. If you go to the next page, I think this is interesting, and I don't know, maybe in your quantitative work if you have any insights on this, but this is the on the bottom panel. This is the put call ratio, and you can see that over time on the sort of on the left side of the chart. One more page.
Sorry.
Going in the other direction.
Sorry about that.
That's okay. Right there. So yeah, on the left side of the page, you can see that this held to a pretty consistent range in terms of what's considered overbought and oversold from a put call ratio perspective. But what's really changed since COVID is the whole curve is just kind of like shifted down. And I just wonder if we're not in a new regime from a volatility perspective, as measured by the put call ratio. But if indeed we are, you can see that whenever the amount of puts being transacted relative to calls spikes, you're at a trading low. And relative to the recent regime, you can see that the pink line in the bottom right hand corner has spiked to the high end of recent data, suggesting that once again, at least within the current regime, we should be and could be at a trading low as well. So that's what I would say. I think the good news is that the leadership remains cyclical. It's very idiosyncratic, and I think in terms of benefiting of being or being dragged down by the factor that you're in has been for really since the early 2000s. It's been driven by what inflation expectations and these other risk on risk off metrics have been doing. Right now they're starting to roll over, which kind of sucks a lot of the energy out of the market. It makes it perhaps more narrowed, but in more idiosyncratic. But the most important thing while all that rotation is taking place is that the safety sectors are not coming to the fore in terms of leadership. And I think that's really important for the longevity of the bull market.
Yeah, that's really neat. I mean, I think this idea, fundamentally, we talk about it in terms of quality. I love what your call out here is that you're not worried unless you start seeing basically soap and utilities surface to the top. If we see that, that's a very different market on an absolute return basis. And certainly, again, another change in leadership.
Right.
So I think that feels about right. And I think, from a strategy standpoint, I think the interest rate story is underneath this, because if you end up getting an overreach in terms of tapering, we could potentially see these valuations break down harder than you think.
Yeah.
Or if the Fed ends up being, let's say, allowing things to run harder, it may be that the capital markets tighten. Maybe we end up seeing the 10-year sell down just because the Fed is not doing anything. Right. So it's a really important pivot point. I think bringing it back to like overall views, at the end of the day, focusing maybe more on the quality, looking out for whether or not quality are good industrial infrastructure companies, or it's, soup and soaps, that's a really critical trigger I think you flag here. The other thing I like about what you've done, and what's cool is that, we're in very different disciplines, but you're bringing up stuff that like inflation and how it links to the size premium. That's stuff that's like really terribly important in our discipline as well. Right. And I think the logic holds pretty well. I think we both agree, though, just in closing, that small caps become very interesting, selective here. It is not like this big sort of swing on the Russell over the S&P. But you do have some interesting pockets here, like value over growth, if you get this sort of like reflation trade. and potentially the aggressive growth names could be the deadweight loss in the Russell.
Yeah, and particularly with I'm not a valuation sensitive investor. I am a valuation aware investor, and I know what these things are trading at. But at the end of the day, this bull market started expensive, and it's just more expensive now. So in the heat of the moment, valuations don't really matter to me. But when you do start to see things start to flag in the other direction, in the level of valuation that we achieved during the last leg up is from a price to sales ratio, there are more stocks with an excessive price to sales ratio today than there were in 2000. And so, we all know what took place when that bubble unwound. And so I want to be mindful of it. But when I see things like that, the ARC ETFs doing what they're doing, and the growth within small caps doing what it's doing, and I know that the valuation spread is so wide, I think really just hunkering down, listening to the message of the market. And if your infrastructure stocks really start to work and there's valuation support there, I just think that's a really good way to engage with the bull market that's still ongoing while at the same time getting the tailwinds of the factors you're identifying.
Neat, very neat.
Yeah.
So we've been speaking with Dave Lundgren. We'll be summarizing this and sharing it, and his details will also be in there. So feel free to reach out. I've certainly enjoyed this. I'm certainly learning from this. It's giving us interesting ways to look at our data and how we're framing the world. So I hope this is informative for everybody, and look forward to having you back on.
Thank you, Satya. I really appreciate it. This has been a lot of fun, and best of luck.
Yeah, thank you.
All
right. Cheers.
Cheers.